Welcome to The Explainer. Today, we're diving into the pretty intense world of algorithmic trading. But we're not going to start on Wall Street. We're actually starting with a university student's final project. You know how it goes, right? When the market is flying high, greed is that little voice in your head screaming, "Buy more, don't miss out," right before the top. And when it's crashing, fear takes over, telling you to sell everything, usually right at the bottom. These emotions are just part of being human, but man, can they be costly. And that's the billion-dollar question, isn't it? What if you could build something that runs on pure logic? A system that's completely immune to that emotional roller coaster that trips up so many of us. A machine that just follows the rules, period. No fear, no greed. And that's where our story really kicks off. A student at the Universidad Politécnica de Madrid, Juan Jiménez Perez, decided to take on this exact challenge for his final year project. His goal wasn't to strike it rich. It was to solve a really fascinating engineering problem. So his objective was crystal clear: design, build, and then test a trading bot completely from scratch. And he wasn't basing it on some hot tip or a gut feeling. No, he was building it on a well-known, classic statistical idea. So let's dig into what that is. The whole strategy, the entire foundation, really just boils down to one simple idea. You can think of it as a rebound rule for the financial markets. It's called mean reversion. And honestly, that's just a fancy way of saying that things that go to extremes usually come back to the middle eventually. A stock that shoots up way too high or one that crashes way too hard, they often have this tendency to drift back toward their average price over time. And this chart is the perfect way to picture that rubber band effect. See that purple line in the middle? That's the average. That's home base. The price is constantly stretching away from it, up and down, but then snap. It tends to come right back. And that snapback is the exact moment this trading bot is trying to capture. But here's the key question. How does a machine know when that rubber band is stretched too far? Well, the student's answer was to use a pretty common technical tool called double Bollinger bands to actually define those limits with math. Okay, forget the complex calculations for a second and just look at the visual. You've got the average price right there in the middle. Then you have two sets of bands, or guardrails, wrapped around it. These create different zones, kind of like a normal zone and then an extreme zone way out on the edges. And this brings us to the bot's super simple logic. If the price stretches all the way up into that top outer zone, the bot sells. It's betting it's gone too far and will fall back to the average. If the price drops way down into that bottom zone, the bot buys, betting on a rebound. And for both trades, the exit is the same. The position is closed as soon as the price gets back to the middle. That's it. Simple, mechanical, and totally emotionless. And this chart shows you what that logic looks like in the real world. These rules aren't just abstract ideas. They translate into these very precise entry and exit points on the screen. Price hits an outer band, a trade gets triggered. Price returns to the middle, the trade is closed. No guesswork, just pure execution. All right, so the theory is solid, the logic seems clean, but here's the moment of truth, the million-dollar question. Does this thing actually work? Let's take a look at the bot's first test run. And wow, at first glance, the results looked absolutely stunning. The student tested this bot on a full decade of market data. And just look at this chart. It's this beautiful, steadily rising line, turning a hypothetical portfolio into over $500,000 in profit. It honestly looks like a perfect money machine. So one of the key numbers they look at is called the profit factor, and it came in at 1.13. What that means is for every single dollar the strategy lost, it made back $1.13. So yes, it's profitable, but you can see that the edge is actually pretty thin. But, and this is a really big but, here's where the story takes a sharp turn. When you actually lift the hood and look at what's going on underneath that smooth-looking profit curve, some pretty serious problems start to pop up. The biggest issue by far was something called false signals. Look right here. The bot buys, expecting the price to rebound to snap back. But it doesn't. The price just keeps on falling, and the bot is forced to get out with a loss. The rubber band didn't snap back. This time, it just kept stretching. And the hard data really tells the full story. The average losing trade was more than twice as big as the average winning trade. That is a massive red flag. It means you have to be right more than 2 times just to make up for a single loss. The system also took a terrifying hit at one point, a drop of over $17,000. And on top of all that, it was just trading constantly, churning out nearly 250,000 trades, and a whole lot of them were just low-quality noise. So version 1 was, technically profitable, but it was also wildly inefficient and super risky. The goal wasn't to just scrap the whole thing, though. It was to make it smarter. And this is where the real scientific method kicks in. Instead of just giving up, the student ran what's called an optimization process. He systematically tested thousands of different combinations for his settings, tweaking the bands, the averaging periods, basically turning all the dials to find the one sweet spot that filtered out those bad trades and focused on the best opportunities. And the results of all that tuning are pretty fascinating. The profit factor, it got a little better, which is great. But the real story here is the risk. That max drawdown, that scary $17,000 drop, it got cut by more than half, all the way down to $7,200. And how did it do it? By being way, way pickier. It took about 70% fewer trades. This really gets to the heart of the trade-off here. The optimized smarter bot actually made less total profit in the test. But in exchange, it created a much safer, much more stable, and way more reliable system. It basically learned how to be patient, how to filter out the market noise, and wait only for those truly overstretched moments. And this might be the most important takeaway of the entire project. And it's a direct quote from the student's own paper. He says, "Even after all this work, you can't be sure it's going to work in the future. You have to keep testing, keep validating. This is such a critical dose of reality. It's not a get-rich-quick scheme. It's a continuous, ongoing process." Which really leaves us with this final thought. Maybe the whole point of building a trading bot isn't to create some perfect system that never loses. Maybe the real goal is to create a system where you understand its flaws so perfectly that you know exactly when to trust it and, more importantly, when not to. Because maybe understanding your system's limits is the real secret to finally taking fear and greed out of the equation.